referendum. Well, let's find out what that's going to mean, certainly for markets, particularly in Japan and the region, and us. George Lucas joins us from Instreet Investments. Now, George, thanks so much for coming in. Now, just in terms of the Japanese election, they're pretty much as expected, a sweeping mandate there for Abe. Do you think he will push with the really hard parts of reform now?
Well, we'll see that very soon. I mean, the first thing they have to do is what he's going to do with their version of GST, which is slated to go up from 5 to 8% by October. And I think, you know, a lot of pundits think that they're going to just keep it at 5%, so we'll see whether that's his first thing that he comes out and does. But there's a lot of wage reform that needs to be done, and there's a lot of, you know, general industrial relation types reforms that need to be done in Japan. And so everyone's going to be sitting on the sideline waiting to see whether we get these economic reforms or whether he spends a lot more time on these nationalistic constitutional changes, which is also very important to Japan.
Because as you were pointing out, there has been some scepticism about, you know, whether Abe's policies are working, and certainly that scepticism is reducing, do you think, from the market?
It's significantly reduced, and so, you know, if we were having this conversation a month ago, it was probably the ability for Abe to pull off his reforms was probably the number 2 worry of fund managers. It's now fallen really nearly off their radar. And so the numbers coming out of Japan are supporting that, you know, the first 2 arrows which he's done, which is, you know, this reduction, you know, the increased monetary supply and a bit of fiscal stimulus, seem to be working. And so we're all going to be sitting watching the numbers coming out of Japan quite closely to see if they keep improving. Well, we have to remember Japan is still the 3rd largest economy in the world and still plays a very important position in the capital markets. So any improvement in Japan can offset any slowdown that we're seeing in China at the moment.
So how do you think fund managers are going to be looking at this? Are they going to be investing in Japanese equities? Is that where they go?
Well, currently we're seeing that happening. We're seeing a lot of fund managers beginning to look at investing in Japanese equities. So they're beginning to get overweight Japanese equities, which is a position they probably haven't had for the last 20 years. And at the same time, they're beginning to position themselves more into the US. The Japanese economy, and especially the Japanese companies, are also very leveraged to what happens in the US as well.
Okay, well, let's talk about the US as well, and certainly one of the big headlines was the Detroit filing for bankruptcy protection there. Now, this has been going on alongside, we've had one of the ratings agencies come out and raise the US credit rating from AAA negative to AAA stable. So does that mean that Detroit and its issues are localised?
Very localised. I mean, the story about Detroit's been going on for 20 years. It's probably been going on for longer as the city's just slowly, kind of, for want of a better word, decayed. And it makes up a very small part of the muni bond issues in the US. And so, although it grabs all the headlines and, you know, may have some sentiment effects, the muni bond market is very big in the US. But the biggest story in the US is really this flow out of bonds and into equities. We're seeing massive outflows from bond funds in the US, and we're seeing massive inflows into equity markets. I think last week was the largest recorded inflows into equity funds in the US since June 2008. Over 17 billion in 1 week went into equity funds. The fund manager reports we see are very similar, where they're selling out of their bond and looking to make it work in equities. So they're really, you know, where at the beginning of the year it was people selling out of commodities and taking money out of cash to move into the equity markets, and we weren't really seeing any net outflows from bonds. We're now seeing massive net outflows from the bond markets.
But you point out there's still cash on the sidelines, though.
Yeah, there's cash on the sidelines because they've liquidated their bond portfolios and they haven't put it to work yet into the equity market, so it's sitting in cash, waiting to get into the equity market. So that's created the cash on the sidelines.
From the earnings season then, so far, and what you're expecting, where do you think in the equity markets that cash will go in the US?
Well, a lot of it will go back to the finance sector. I think the finance sector has surprised everyone in the performance.
So even though it's kind of been the standout, the darling of the sort of earnings season so far in the moves.
It's been the darling of the earnings seasons, but the tech stocks have really been the darling of the market, which people have been allocating to. And even though they're overweight finance, the finance sector has lived up to expectations and actually beaten expectations. So we should see them continue to rally. It is quite interesting because there's a lot of regulation, not just the commodity things that you've been talking about this morning, but there's, you know, a lot of regulation going on in the banking sector in the US, and it doesn't seem to be slowing down the earnings of the US banking sector.
Okay, because there was that sort of short headline, not a lot of detail around it about the Fed reviewing that decision, you know, to allow banks to
and
trade
that's just
commodities.
one of the many. That's just one of the many things. Like there's talk about the larger banks will have to have double the capital of the smaller banks in the US, and there's all the Dodd-Frank derivatives which have started in May and coming in, and then all the European derivative regulations come in, and these banks actually function more on derivatives than they do on anything else, and these are slightly big regulation changes for them, but they seem to be coping it in their strides at the moment.
Just got to ask you about China too, because obviously we've seen this announcement removing the controls on bank lending rates. For you though, this is just what, more a symbolic step?
Yeah, it's just a symbolic. I mean, I think last year only 11% of loans went below the benchmark rate, and the big corporates have begun using the bond markets of bypassing banks to raise funds. So the actual lending rate from the banks is not important for the big companies, and as I said, only 11% went below that benchmark. But from a symbolic point of view that they're trying to liberalise their market, it's obviously a big step for everybody. Saying that, the Aussie dollar did rally on the back of it, as did a lot of other commodity currencies, because they thought it was a little bit stimulus for the economy.
Just quickly, in a minute or less,
yeah.
how are you changing your investment strategy? Because I know you like the contrarian play, and if, you know, all the money's going into US equities.
We're still very much in the US equities.
Okay.
I mean, the US is where you want to be at the moment.
All right. George, great to get your thoughts as always. Thank you
Thanks a
so
lot.
much. George Lucas there from Instreet Investment. Coming up on First